It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. And yes, you will reach me. Again, that's yourpersonalbank.com. So I've been discussing on this show for quite some time how the U.S. Labor Department has been reporting jobs numbers for the last year or so, and then revising those job numbers the next month or two downward significantly. In other words, they're playing with the numbers. There are no revisions to the upside. So this isn't done in error. JP Morgan has estimated the downward revision would be over 300,000. Goldman Sachs has stated it could be upwards of 1 million less jobs over the past year than what the U.S. Labor Department has reported. Now, the headlines are stating how these jobs had vanished. Let me be very clear, folks. The jobs that the U.S. Labor Department over-reported and then later downward revised, and looks like they're going to do so again, those jobs never vanished. They never existed in the first place. The current administration, the U.S. Labor Department, has been putting out rosy or optimistic labor numbers to make things look good, better than they really are. In other words, they're politically motivated, trying to make the current administration look good, and then later reporting lower numbers, revisions down. A month or two later, they report the lower numbers when nobody's really looking. Now, it's abundantly obvious that this is politically motivated. It was politically motivated, make the numbers look better than they really were. Because one of the things the Biden administration had been echoing and repeating constantly is how, unemployment is low, jobs numbers are up, and all this kind of stuff. They kept saying that even though it wasn't really the case. It wasn't the fact. It was a lie. And now even the federal government is admitting to that fact. Now, why are they doing that now? Well, again, you have to think about political reasons, and it's abundantly obvious that now that Biden is officially not running for re-election, they can dump the real numbers and hope that nobody blames Kamala for that, even though she repeatedly stated how it was the Biden-Harris administration. Remember that? So in other words, our economy has not been anywhere near as strong as they claim it to have been. One of the bright spots, obviously, was always the low unemployment and the strong jobs numbers. And it's turning out that those jobs numbers were far weaker than what the government was telling us all along. Now, I know this may sound a little cynical, but whatever this revision that they come out with here, and by the time you listen to this show, they may have already announced that, I would be dubious of those numbers too. I don't know how accurate they really are, because they lied to us before. What would stop them from lying to us again? Why should you trust them? But we'll see what happens. Another key point here is credit card defaults are now at record levels. They are approaching 8%. Now, that is the highest level since 1991, I believe, since they've been tracking this. And in fact, credit card default levels are now higher than they were in both the 2001 recessions and the 08-09 Great Recession. That does not bode well at all for the economy. One of the primary reasons why credit card balances are at all-time records and now defaults are showing at the highest levels, well, I think since they've ever measured it, is because of the higher cost of living. Inflation has caused a lot of people to dip into savings to maintain their lifestyle, or in some cases just to buy basic goods and services that they need to live on, and they've been supplementing that through debt. That can work for a while, but it will only last for a certain while, and now defaults are starting to rise. Again, the highest level since 1991, and I believe the highest levels we've ever seen since they've been tracking it. Also, another bit of information that's concerning, U.S. bankruptcy filings in the second quarter of 2024 have hit the highest level now since 2017, since In fact, the number of companies declaring bankruptcy has now doubled in the past 2 years, and Chapter 7 filings, which are known as liquidation bankruptcies. There's different types of bankruptcies, but a Chapter 7 is when a company just goes out of business, period, has reached the highest level since the pandemic. Now, I think it's fairly obvious that many of these bankruptcies of individuals and companies are because they were carrying debt, probably too much debt. The cost of debt borrowing was low for over a decade. And of course, the last couple of years, that cost of borrowing has increased significantly, more than double in most cases. And unless a company is profitable enough to handle the higher cost of the paying the interest on the debt, ultimately they're going to go out of business. Now, even though bankruptcies, high levels of bankruptcies, is not good news in general for the economy, obviously it's not. But in some respects, there is a silver lining, because what it does is, just like a recession does, bankruptcies allow the economy to shed off the excesses. As I've stated on the show many times, nobody enjoys a recession, but recessions are necessary. They're part of that healthy cycle. It's much like I was thinking about this the other day. It's much like the seasons. Most people don't like winter, particularly if you've got a really cold, brutal winter. It's not great for living, but you can't have spring without the winter. That's the rebirth, when everything comes back. And recessions are basically the winter of an economic cycle. I believe, if you have to ask me my opinion, where we're at right now in the economic cycle, I would say we're definitely in late fall. We're not in winter yet. The recession hasn't hit. I believe it's going to get worse before it gets better. But the warning signs are there. The nights are definitely getting colder. You can smell it in the air, and winter is coming. Everything in your being tells you, everything around is sharing with you, that winter is coming. I believe recession is coming. I've been discussing this for a while on this show. Not to be a scaremonger or anything like that, just to share facts so that people can make better financial decisions. If you know what's really going on, you can make better decisions for you and your family. Another key bit of information I think is very important is, according to a recent report from Florida Atlantic University, they find that 94 U.S. banks are at a significant risk of experiencing bank runs by uninsured depositors if they show financial weakness. Now, this is kind of interesting because, as most people know, an FDIC insured bank will guarantee or insure up to $250,000 deposit. The higher amount of money that a bank holds, uninsured deposits that is. So these are deposits that are far larger than $250,000. In most cases, these happen to be business accounts. But these accounts that are bigger than $250,000 are very susceptible to a bank run or a bank showing any form of weakness. Because if the bank fails and FDIC does take over, there's no guarantee that money in that bank that's over the limit, the $250,000 FDIC limit, will be insured. In other words, those depositors could lose that money. And it turns out that BNY Mellon Bank has a 100% ratio of uninsured depositors, which means they have as much uninsured money in their bank as they do insured money. Now, I'm not sure if BNY Mellon is a bank at risk, but if they do show any weakness, they would have a bank run. A lot of those depositors would take their money out very, very quickly. That is what happened about a year or so ago. We had a bank run on Republic First Bank and a few others, if you remember. They had a high percentage of uninsured deposits. Now, in their case, the FDIC did step in and took over all that deposits and made them whole, but there's no guarantee that actually would happen. So some of the other banks on this list, other than BNY Mellon, happen to be State Street Bank at 92%, Northern Trust, Citibank, HSBC, JP Morgan Chase, and US Bank. These are all banks that have over 50% of their money in uninsured deposits. In other words, they happen to hold a large number of large deposits or large accounts well over the $250,000 limit, or the FDIC insured limit, we'll put it that way. So the risk of the bank failure or a bank run is higher on those types of banks. Now, I'm not saying you should pull your money out of those banks or anything along that line, but what I am saying is you do want to keep a close eye on that type of thing if you have an account with any of those banks or business account, anything like that, larger than the $250,000 insured FDIC limit. And like I said, I'm speaking from a place of credibility. I was the chairman of the bank of an FDIC insured bank for a couple of years, so I understand how this works. So just giving folks a heads up and a good warning to let them know what's really going on. There's a lot of information, as I was stating, the way it looks like things will be headed here in the relatively near future that I'll be sharing with you here in the next segment. But if you do want to contact me to learn how to thrive, not just survive through an economic downturn or uncertainty for that matter, higher interest rate environment, higher tax environment potentially in this next year, if the current tax laws do indeed expire, as they're set to do as we speak. If you want to thrive in that environment, there's opportunities with guaranteed accounts that we haven't seen in 40 plus years. This is the best time because of the higher interest rates. I encourage you to contact me at yourpersonalbank.com. I'll be happy to help share with you how you can thrive through this. Because the last thought I'm going to share with you on this is the past decade was the decade of low interest rates, easy monetary policy, assets that thrive in that type of environment, like stock market, real estate certainly did. But we're in a different economic environment. And things that thrived in the past decade are probably going to struggle in the next decade. And the things that didn't do so well in the past decade are probably going to thrive in this decade. I've got some receipts that I'm going to share with you in the next segment that you're going to want to know about. So stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to contact me, you can do so at yourpersonalbank.com. Yes, you will reach me. Again, yourpersonalbank.com. So there's a recent analysis by Piper Sandler. And what was interesting about this is they were pointing out the striking similarities to the recessionary periods of 1970 and 2001. And they pointed out how similar they were to 2024. Now, except for there's a few critical differences that they state could lead to a far more severe downturn. As they stated, both in 1970 and 2001, we saw a situation of a big shift up in inflation. In other words, inflation rose, tightening cycles and bubbles in both tech and consumer goods. We're seeing that, of course. Now, as I stated, in both of those periods, 1970 and 2001, consumers were significantly stronger position than they were, and the consumer bubble was not as big as it is this time. In other words, the consumer was in a better position, and that helped offset those recessions because consumer spending remained fairly resilient, as they put it, preventing a severe decline in gross domestic product. They believe this time around it could likely be far more severe because, one, the consumer bubble is, as they stated, 4 times larger than the Y2K bubble. Also, as they state, the consumer is in a far weaker position with high levels of debt, low levels of savings, and their bottom line conclusion, as they stated, is with the combination of the weaker consumer base and the unwinding of the stay-at-home bubble could lead to a far sharper economic downturn than we saw in those previous recessions. So not only is Piper Sandler stating that they are expecting or likely expecting a recession is looking very, very much like 1970 and 2001, as they stated, but it could be far worse than those. And if you go back, and I remember the 2001 recession, I was in the financial business. This is my 25th year, as I've stated. This is not my first rodeo. And I saw how that affected a lot of people in their investments and their retirement and the stock markets and real estate and all those types of things. And folks, it wasn't a pretty picture in many cases. It was a tough thing to get through. It was stressful. Yet, I had clients who, either due to their more conservative nature or being more risk adverse, or saw the writing on the wall. As I stated in the last segment, if you had to ask my opinion, economic cycles come and go just like seasons come and go. And yes, there will be a spring, there will be a rebirth, and things will get going again, of course, but you have to have the winter before the spring. You can't have the spring without the winter. That's just how it works. And if you had to ask me where we are right now, I'm going to tell you we're in late fall, is my opinion. Now, when is it going to happen? Unknown. How long? How far? No one can answer those questions. But the signals are there. The writing's on the wall. It's like this changing of the seasons. The nights are getting cooler. The leaves are changing color. There's a smell in the air. You can feel it. You know when fall is happening, and you know when winter is coming. We just know that instinctively because we experience it. It's no different with economic cycles, folks. And it's not that any of the cycles are bad or one's worse than the other. It's just they are what they are, and you have to recognize what they are and deal with them accordingly and readjust your portfolio or your plans or whatever you're doing to fit whatever the current cycle is. I had a discussion with a very interesting person today, in fact, a business owner. He's been through a number of different businesses, a number of different economic cycles, and he's had some successes and some failures, like many entrepreneurs have. And it was interesting how he pointed out that much of the success economically, whether you are a household or a business, is recognizing what cycle you're in. Why are Chapter 7 bankruptcies risen to the highest levels we've seen in years? It's because those businesses aren't thriving in a higher interest rate environment. They're not thriving in an environment where they have to maintain higher levels of debt. Now that the cost of that debt has gone up, now this isn't every situation, but certainly a lot of them, those businesses that are carrying a lot heavier loads of debt are going to struggle more right now than they did a couple of years ago. That's just a fact. And if they can't increase their profits, reduce their expenses, and manage that change, they're going to fall. They're going to fail. There's going to be more bankruptcy. Overall, in the economy, part of that is healthy. The inefficient businesses get washed out during recessions, during times of winter. That's part of the cycle. That's normal, folks. Now, if you happen to be involved at that business, you have to recognize that change and try to make that adjustment. As I used to say, one of my businesses that I owned some years ago, my statement was evolve or die. So like the dinosaurs. The dinosaurs were unable to evolve, and of course they died out. In business, that's how it operates. You have to operate the same way. So I thought it was very interesting. We had a great discussion. I have fun, really enjoy talking to people like that, like-minded folks, if you know what I'm saying. And we also discussed how your personal bank can assist in helping a business like that or a person like that because, well, for one, by building a cash reserve, obviously you create a cushion and of money that's easily accessible. As I stated with this business person, he'd had an issue with a partner, which caused his credit to go way down. He had had great credit for decades, literally, and because of the situation, his credit was way down. He needed access to some more funds, yet he had poor credit. Isn't it interesting? So obviously, you have a hard time getting financing at that point. I think it was Mark Twain that said a banker is a person that'll give you an umbrella when the sun shines. In other words, when it's raining and you need the money, that's the least likely time you're going to have access to it. Well, the beauty of the personal bank is if you've built up a cash reserve in there, you have access to money at any time, no limitation. It doesn't matter what your credit score is, and it's insured, so it's not going anywhere. So the money's there, highly liquid. You can have it in a matter of days. No questions. You don't have to qualify. You don't have to go through a credit check. You don't have to get anybody to approve it, go through an underwriter or anything. The money is yours. It's there. You can leave it there and let it grow when you don't need it. And when you do, it's there. And oftentimes you can even create positive arbitrage by having this situation where the borrowing cost is less than what you're earning. So you're actually still earning some money on that money while you use it and need it. And please understand, this is super important, not only for business owners, but individuals. It's during economic downturns, recessions, winter, if you will, is when people typically have the greatest need for money. It's when they're down, something bad happens to them personally or their business or the economy, and that's when that's the hardest time to get money, because if their business or income's been hit or hurt, their credit's been hit, they don't have as much access, if any, or they have to pay a far higher percentage rate for it, costs them far more. Also, banks tighten up lending standards, which makes it even harder for even people with decent or even good credit to get money. My point is the personal bank can create that cushion for you. And I saw that. Most recent example was, of course, in the COVID shutdowns. A number of people losing their jobs or businesses being shut down through no fault of their own. And suddenly they had a need for money. And I can't even count how many people who had been funding one of these policies, their money growing safely, insured, guarantee. Yeah, by the way, if you have it in assets that can lose value, when do assets tend to lose value? When does the stock market typically go down? When it's a recession, when there's a crisis, when it's economically winter, right? So now maybe you've had an income situation or business situation. You have a need for money. The economy's gone down. Your assets have gone down in value. Now you need to access money. I have seen this so many times over and over again. And you're forced to take out monies out of an account when the asset values are down. So now it's like a double whammy. It's like a dog getting kicked when it's down. That's how I've often stated it. And I've been there myself. I know how it feels. It's no fun. Again, if you have some assets in a personal bank policy, it's insured, guaranteed, tax-free, and highly liquid. That's a key point. It doesn't go down when the economy takes a downturn or asset values drop. It's guaranteed. It's insured. In fact, it continues to go up. So not only do you have the money available when you need it, you have more of it available in the future. Guaranteed. Folks, that's powerful. Having that made the difference. I can tell you for many, many of my clients, when their businesses or jobs got shut down because of COVID, for example, and it's what got them through until they could figure out how to fix their income problem or get another job or whatever. And it actually, the funds that were in the policy had access to it, so it could get them through that period, to get them through that downturn. We will have a downturn. It's part of the normal economic cycle. It's just like seasons. There are 4 seasons. They happen every year. Some are worse or more intense than others, but they happen, and economic cycles do too. Some are stronger than others, but they happen. That's why when people ask me, will we have an economic downturn? Will we have a downturn in the markets? Things like that. The answer is, of course we will. It's just a matter of time. We don't know when, how long, how much, but your personal bank can be that cushion for you, have that access to those monies when, if and when you do need them, and they can continue to grow and guaranteed and ensured you even have more in the future. If you want to learn more about this and how it could enhance your financial picture, your portfolio, your situation, your business, whatever it may be, contact me at yourpersonalbank.com. I'll be happy to help with you and share with you how, it can just take off some stress out of your life. If you know what I'm trying to say, knowing that money's there no matter what.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. You can contact me at yourpersonalbank.com. Yes, you can reach me. Again, it's yourpersonalbank.com. In the last segment, I was discussing how your personal bank having guaranteed monies, insured, guaranteed, tax-free, and highly liquid is so important for when an economic downturn does occur. Just like the seasons, winter will come. Economic cycles do the same thing. It's coming. We just don't know when exactly. But why this is so important, this article here, or JP Morgan stated, the brutal rout in stocks this month was a dress rehearsal of what's to come. This past month was the worst we've seen in 2 years, as they stated, in the stock market. And as they stated, it might have been a preview of what's to come. I stated a week or two ago how I believed it was like a warning shot. And as the analysts of the bank said, the combined worries of decelerating economic growth and the carry trade unwind were too much for the market to handle at once. And yes, it's clawed back much of its losses, and some are stating, oh, this event was just an overreaction to a momentary blip. Many participants are dismissing the blow up as a flash crash, but it's more of a dress rehearsal of what's to come. And a lot of this is due to the weakening unemployment numbers. I stated in the very first segment how the federal government has finally admitted now to over reporting the numbers, and they're doing they've been downward revising the numbers almost every single month for the past year or so, and now they're going to revise those numbers downward even further, upwards of potentially 1 million jobs in the last year. That's a huge number, folks, in a downward revision. And a lot of people are saying these are lost jobs. No, they're not lost jobs, folks. They were never there. They never existed. They were over-reporting. They were cooking the books. They were playing with the numbers to make it look better than it really was, okay? So as JP Morgan is stating, the risk is higher, no question, and it doesn't look real bright going forward. The risk is significantly higher in the markets. And this Business Insider article I thought was quite interesting, and it stated why your favorite S&P index funds are in for, quote from them, a decade from hell. The reasons they stating that is that the current high valuations, again, it's at or close to all-time highs, suggest poor returns for the S&P 500 over the next decade. There's a Shiller CAPE ratio is what it's called. And its prediction is that we're going to see low annualized returns roughly of about 3% on average over the next decade. Now, this Business Insider article, I know that may sound shocking, but this Business Insider article said you've probably heard over and over again, buy an index fund, don't touch it, and watch your nest egg grow. And as they stated, history has proven this to be a brilliant strategy over the long run. But they also point out that if your time horizon, if your target is about a decade, this is one of the worst times to be investing in the market. Much like real estate, a lot of experts are pointing out, hey, how we've seen such a dramatic increase in real estate values over the past few years. The affordability of real estate has never been worse. You could basically say the same thing about the S&P 500 and big parts of the market. As I stated, the market has gotten so frothy in terms of valuation that it's setting itself up for abysmal returns over the past 10 years or so, and that's what the numbers show. The Shiller indexes and forward price earnings ratios and all those types of things are pointing that out. So is what's called the Buffett rule, the value of stocks to GDP. It's an obvious reason of why Warren Buffett has sold more stocks last quarter than at any point in his entire career. And that guy's known as one of the top, probably if not the best investor in history. And the last point about this article I thought was interesting. It's an analysis by Michael Fink. He's a professor of wealth management at the American College of Financial Services. He's discussing the CAPE ratio. And what it is it's a 10-year rolling average of the 12-month trailing PE ratio. So it normalizes out the measure, it smooths out the outliers, okay, the PE ratios. And as he stated, the CAPE ratio has a remarkable ability to predict future returns. He ran a regression analysis, which is a statistical test, and it identified that between 1995 and 2010, the CAPE ratios at any point identified about 90% of the S&P 500's returns over the following decade. So it's has been extremely accurate at predicting what future returns are going to be over the next decade. The relationship between the CAPE ratio and future returns, as they state, bodes very poorly for the next 10 years. The CAPE ratio is at its highest levels it's ever been, with the exception of 1999 and 2021. The statistical analysis of the Shiller CAPE ratio estimates annualized returns over the next decade to be about 3%. Now, that may or may not end up actually happening. If you have the ability in your personal bank policy to grow your money, get dividends at 6% plus, insured, guaranteed, with guarantees, tax-free, highly liquid, really, why are you risking a big chunk of your money in the market, which, according to the Shiller CAPE ratio, is predicting about a 3% average return? If you look at annuities, I've got annuities that will pay 7, 8% guaranteed first year, with the ability to earn index returns in the future with no downside risk. So you can take advantage of the upside without risking the downside. If indeed the next decade pans out as the Shiller CAPE ratio is predicting, your personal bank policy, high cash value policies, dividends, even annuities, will outperform significantly the overall indexes. Now, that has not necessarily been true in most cases, although there have been exceptions to it, as I've seen myself in my career, depending on when somebody started investing. 2000 was a peak, 2007 was another peak. And if you'd invested in at or near those peaks, it took a number of years for you just to get back to where you started. So a lot of it has to do with where you're at, where you're investing, when did you start. And then the last point, I have a lot of people I talk to. I get that. I'm concerned about the future returns, but I bought these things so long ago at such a low price that I have a big capital gains tax. Well, here's what I would say to you. Currently, depending on your income, I've shared this a few times on this show, you may have the ability to sell some of your assets that are subject to capital gains and be subject to no capital gains tax. It's based on income, which is far higher than the average American, by the way. Also, even if you don't qualify for the zero capital gain because your income is too high, long-term capital gains rates are 15% right now, folks. That will be the case in 2024 and 2025 unless Congress extends the current tax brackets. Long-term capital gains rates will go up in 2026. The tax rates will revert back to the higher levels. So you have a couple of years to take advantage of lower capital gains rates. I have a simple question. Do you want to pay capital gains when they're at a lower rate or in the future when they're likely a higher rate? And again, that is the law on the books as we speak. So unless Congress passes a law to change that, to extend it, I should say, the tax rates will be higher in a couple of years. A lot of things have to happen for Congress to extend that. Let's assume the Republicans win the House and the Senate and the presidency. There's no guarantee that they're going to extend the current tax rates. So we have to plan with the rates, the rules, as they stand. We got a few other things going on that are not pretty. And here's one of them. $200 billion roughly to Ukraine, $450 billion a year spent on housing and food for illegals, about $8 billion a year to the UN, $50 billion to climate change initiatives just in 2023 alone. There's $1 billion per year to the Paris Climate Accords, about $500 million a year to the WHO, 3/4 of a billion a year to NATO. The bottom line is, when you add all that up, we're approaching $1 trillion a year on globalist junk, climate change, mass migration, all those things, which none of those things benefit American citizens. As long as this level of expending continues, of course, we are going to continue to see more inflation in the future, which bodes poorly for future stock market returns or other assets for that matter. So again, looking at an alternative, a way to diversify, guarantee, protect some of your portfolio, have it highly liquid with less taxes, only makes sense. Contact me at yourpersonalbank.com for more information if you want to look into this and, well, frankly, learn how to thrive through this situation's uncertain economic future. Stay tuned in the last segment. I got some information, well, you're just not going to want to miss.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. You can contact me at yourpersonalbank.com. Yes, you'll reach me. Again, it's yourpersonalbank.com. So I know a lot of the media and a lot of people are trying to say, well, with the lower inflation rates, it's behind us, it's getting better. We should kind of put it behind us, not worry about it too much more. Here's the problem. In the past 3.5 years, gasoline has gone up over 50%, electricity over 30%, groceries about 25%, rent about the same, roughly 25%. Car insurance is up over 50%. My point is this. It's not the annual increases that's important. It's the cumulative effect of all the inflation that's what's hurting American consumers. It's why we have record credit card debt and now record credit card defaults. People are using debt to finance their expenses or to finance their their lifestyle, I should say. Well, generally speaking, that's not good. That's not going to last long. We'll put it that way. If you're borrowing money just to maintain your current lifestyle, that's not going to end pretty. There's a couple of solutions, and I was discussing that with a person that called me today that I thought was very interesting. He stated he's listened to me discuss inflation a lot and this and whatnot, and he said he feels a lot of what inflation is really personal inflation because people are still spending the money. And I said to some degree I agreed with him, but not completely. And here's why. Is it true that some people are spending money still because they got used to the extra money they received from COVID or other sources? And so they had excess savings, so they started spending more, living a better lifestyle, obviously. And now that's gone. It's been spent for the most part. The average American has spent it. And now they're continue to live that lifestyle. Certainly. There's certainly a good chunk of that going on out there. Is that sustainable? No. That's why we're having record credit card defaults. If you're in that situation, you got to reduce your spending, or eventually you're going to get forced to reduce your spending, right? We could say that about the federal government too. That's why I rail on all this excess spending of the government, frankly, spending more than it receives because, well, it's unsustainable. Eventually, if this continues, we're going to be forced into austerity measures. And ultimately, as we discussed on this call, the ultimate fault, we blame the politicians a lot. That's true. I think a lot of them gone rogue, promise one thing and just doing what they want or whatever benefits them. But at the same time, ultimately, the ultimate responsibility falls on the American people. We vote these people in, and if they spend too much, if we reelect them, that's our fault. We need to educate voters. We need to educate citizens. And we need to be against any politician that spends more than they receive, that is overspender. Just like we have to get our household finances in order, it's not fun. It's not a fun process. We have to do the same thing with the public money or the federal government. And that's what I try to do here. But also, as I discussed with this gentleman, I don't believe all of this is personal individual's fault either. Some things we don't have control over. Food, if you need gas, let's say you need to commute to work or something, that's how you make your living. You don't have a lot of control on how much you can spend for gas. With food, maybe you buy a cheaper item, maybe you buy hamburger instead of steak, but as I stated to the gentleman, the hamburger itself has gone up 50% in the last 3.5 years. So yes, it may be cheaper option, but it's not exactly cheap. It's probably more than it was 3.5 years ago, what you were spending. So the overall costs have gone up. And unfortunately, for a lot of people, that is unavoidable. And it does hurt lower income people more than higher income people. That's just a fact. Bigger point I made then with this gentleman that I thought was interesting is, what kind of country do we want to live in? I mean, this is America. It's supposed to be the land of opportunity. It's supposed to be a place where somebody works hard, does the right thing, and can improve their lives. Inflation certainly makes that harder, makes it far more difficult. And the cause of the inflation, of course, is overspending. This wasn't an issue generationally. If we go back a generation or two, we were not a society of overspenders, but in a lot of ways, we've become that. This is an attitude. It's not a popular one. I get it. It's not fun, but it's something that needs to change. Look, we're going to change the attitude in our society regarding spending, or we're going to do it voluntarily, or we're going to be forced into it eventually. I would rather do it sooner than later. I would rather do it more voluntarily. Being fiscally responsible, it'd be less painful. If we get forced into it, it will be very painful. And those that think, well, I'm old enough, I'm not going to see it, folks, I believe that's going to happen far sooner than you probably think. I think Milton Friedman might have said it best. Milton Friedman, by the way, was a very influential economist. And as he stated, keep your eye on how much the government is spending, because that is the true tax. As he stated, there's no such thing as an unbalanced budget. You pay for it either in the form of taxes or indirectly in the form of inflation or debt. We're seeing that today as we speak. If our government spends more than it receives, you have to look at that as a tax. You have to consider it as a tax. Because again, what is a government going to do if they spend more than they receive? They're going to print more money. And by the way, anyone, and again, quoting Milton Friedman again, anyone who blames any group or organization other than the government for inflation does not understand what's going on. If they attribute inflation to other groups, they're wrong. And here's why. Consumers don't produce inflation. Producers don't produce it. Trade unions, sheiks, oil imports. What produces inflation is too much government spending, too much government creation of money, and interference, too much interference through regulations. Like in the energy industry, as we've stated many times, those are the causes of inflation. So the cause is government, bottom line. And I think Ronald Reagan probably said it best when he said, we don't have inflation because the people are living too well. We have inflation because the government is living too well. And I think that is absolutely perfect explanation of inflation. And to exacerbate that situation, it's an insanity when you have a government paying illegal immigrants 2, 3, 4,000 a month in federal assistance, food, housing, all of that stuff. While the average Social Security check in America right now is about $1,200 a month, that's insane. And then a new one that's coming up, again, just going to make things worse. The Biden-Harris administration will start forcing states to fund health care costs for illegal immigrants starting November 1st of 2024. And as we speak, the average U.S. family pays about $24,000 per year for those same health care costs. Now, why are they doing all this? Well, it's really quite simple. The Biden and Harris administration has also shortened the naturalization application. It's raised the fee, but made it easier for low-income people to qualify for a discount, and turns out to be about the only area of the federal government that's efficient or has gotten more efficient. It's cut down the average time for illegals to become legal. And the reason is quite simple. There are now 5 states where the secretaries of state have reported they have found illegals on the voter rolls. And not a few, they have found thousands. We need to contact our secretaries of state and demand that they clean up the voter rolls and not allow illegals to vote. Call them, contact them, demand it, because the reason is simple. If the U.S. Census only counted U.S. citizens instead of illegals, California, New York, and Illinois would lose a combined 18 electoral college votes, folks. They would also lose 18 seats in the House of Representatives. So whether these illegals vote or not, it does not matter. These are strong blue enclaves, California, New York, and Illinois. The Democrats would lose 18 seats in the House and 18 electoral college votes. That is why they want them here. The illegals don't even have to vote if they can submit a ballot for those people. In fact, they don't even have to submit a ballot. They just get more representation in the House and in the Electoral College because of the U.S. Census. Folks, that is the reason why. We need to be aware of that and understand that and then fight against it. Again, you cannot fight your enemy if you don't know what you're fighting against, can you? The first step is education and understanding. I'm going to encourage you one more time to contact me if you want to learn how to thrive through these economic and political uncertainty that we're dealing with over the next several months at least, if not the next several years. You can thrive. There are options available. You don't have to ride the roller coaster. You don't have to worry about or be stressed about what's going to happen. You can kind of set it and forget it if you want. You also can have high liquidity of your money, as I've stated many times. So if you need access to your money, it'll be there, particularly in a crisis when you would most need it. It would be there. It's insured, has guarantees. It will continue to grow every year, so you'll have more money even through a crisis in following years. Contact me at yourpersonalbank.com if you want more information or discuss your situation. As always, stay tuned to the Your Personal Bank show next week. I'll have more great content to share. And as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.